Okay, should we get going?
Yeah.
Good.
Right,
Good morning. Are we live? We're live, I think.
Yes, we are.
Good. Well, good morning from Bucharest and from our speakers from London and Kent. Welcome to this morning's webinar through the British Main Chamber of Commerce. I'm Neil McGregor, the chairman of the chamber, and I'm very pleased to welcome our speakers today, Emma White, Alex Courtry, and Luke Walden. And if you look at the chat box, which you'll see at the bottom of the screen, you will find a link to the Chamber's webpage, which gives the details of what we're talking about today and the background of our speakers. So we've woken up this morning to new restrictions being applied in Bucharest, where I'm sitting. And following what's happening in the UK, there are similar things there. So certainly, I think we're living in turbulent times. Now, the Chamber is a business organization, and businessmen just as much or more so than they would do in ordinary times. So we're particularly pleased to have had this morning's presentation on how to protect against those pitfalls. A few words of administration. We are obviously here on Zoom, for those of you watching on Zoom. We are also live on Facebook, and this presentation will be recorded, be accessible to our viewers on the Chamber website. They can't attend us at the moment. You will be able to ask questions. Please ask your questions in the chat box. If you're watching us on Facebook live, please post your questions there, and our colleague Anna will monitor those and pass the questions through. The speakers are happy to take questions during the course of their presentations, and there should also be a question and answer session at the end of the presentation. So our first speaker is Emma White of A&G Chartered Accountants. Emma, the floor is yours.
Right, morning everyone. I'm going to talk to you a little bit about obviously my concerns at the moment. So I'm partner at A4G, and I also head up our cloud accounting department. So one of my focuses at the moment is obviously helping businesses to sort of understand how to stay ahead of competition and particularly monitor their figures sort of live. So one of my big concerns at the moment is obviously for businesses that we're working in a period where for a lot of businesses it's maybe harder or more expensive to make the money they were previously making and to run their businesses. And obviously we are heading to a time where actually there is going to be a pinch point for businesses, and that will depend on sort of the normal business cash flow cycle and where are the areas that are of concern really. So as many of you know, the government here in the UK have extended sort of the deadlines for paying back sort of deferred debt, but obviously that means you're having to make sort of more money after tax to repay those debts. So you know, we've got things like obviously the wages are now sort of out of furlough. We're into this sort of job retention scheme where it's all a bit uncertain, and actually if you've only got people working for a third of their time, it can be quite expensive. You'll have rent arrears, potentially corporation tax deadlines coming up, and all the things like we're seeing the personal tax that will be due in January all being pushed back and spread over a longer period. But obviously all these things will have to be repaid at some point. And for many businesses, you are now trading with people that have been given more credit potentially than they would have been allowed had they gone through the proper lending channels. And they also won't have considered lending in the same way that they would do normally in terms of sensible proposals for repayment. So it's, you know, it's quite a scary time for business owners, and I think it's hard to know what you should be monitoring. Now at A4G we have this little tool that we run for a lot of our clients where we do monthly sort of financial director services for them, and we call it our 5-minute cash flow tool. Now, what we do is use this month on month just to build a bit of a picture about where the business's cash flow sits. And we look at the balance in the current account at the moment, you know, what's in deposit accounts, what sort of overdraft limits have they got? And that gives you an idea of what cash you've got available. And then we will help them look at all the debts that are sitting in the background that sometimes sit off balance sheet, particularly things like the company tax bill that's accruing and doesn't always get put into a set of accounts. So it just takes into account sort of what the debt will be, or what we estimate it to be, when it's due for payment, and how many months until you've got to find that money. So this gives you an idea then of where you're sitting in terms of what you owe at today's date compared to what cash you've got available. And obviously in this example, the business had £50,000 of cash available with bank and overdrafts, but actually £86,000 in debt, and it predicted a shortfall. Now that's actually not an alarm in itself, because a lot of businesses use their sort of finance facilities and their creditor sort of payment terms to trade. But obviously the closer you get to things like corporation tax bills, that shortfall shouldn't be increasing. You need to be able to manage that. And this just allows businesses to sort of predict where they are in things, and just monitor as sort of bigger bills come due where they are. And it's always better if you know what you need to know, isn't it? So that's one of the things we do for our clients, but we also help them with streamlining their finances to improve cash flow. Now that we work with a lot of our clients on using online cloud accounting systems, which I think now, if you're a business, you need to be using these systems, just because a lot of your competition will. And if you're, you know, if you're in the sort of habits of only doing it once a quarter for VAT returns, or worse, maybe pulling stuff together once a year for your accounts that don't need to be submitted for 9 months, you're so behind in the information you've got available to you that you can't make easy decisions. So we talk to a lot of our clients about speeding up invoice payments. So the reason we work really closely with a lot of accounts packages, but the one we really favour is Xero. And that's because you can do online invoices, link it to online payment methods. So it's really easy when people open your invoices, there's the pay it now button, and they can click through and make a payment, or a direct debit system. And then also some of the cloud systems have this sort of automatic debt chasing, which just really helps. Polite persistence pays, and it just means that you're applying best business practices all the time, even when you don't necessarily have time to do that. Now, we would then pair that with an app called Fluidly. Now, Fluidly is sort of an automatic debt chasing and cash flow, sort of short-term cash flow app. And the reason we like that is because you can design your cash flow, your sort of chasing emails, in a really nice way. So it would send a copy of the invoice a few days before it was due for payment, saying, you know, just to let you know, this is due for payment in a few days. Please just add it to your payment run. Then obviously that can escalate, and you can, you know, sort of the deadline's passed a few days ago. Please, can you make sure this is on your system for payment? And all those little polite reminders are then done automatically and designed by the business owner or whoever's in charge of finance. And they come from that person's email at a time that's sort of is relevant for the business. And it just helps nudge those debtors along, freeing up the time for people to actually pick up the phone for any of the ones that are outstanding for a little while. And they are the businesses that you need to be chasing at the moment. So all of this just feeds in really nicely. And then it has a sort of cash flow modelling tool off the back, where it will predict your cash flow based on the patterns of payment by those customers. So it's not a case of making an assumption that all customers pay on the 30 days. You know, customer A might pay on 15 days, customer D might pay on 60. This modelling software will actually factor that into your cash flow, so it's much more realistic for you as a business owner, and it just gives you a live picture of where your cash flow's at. So that's why I'm a big advocate for Xero. Is not necessarily because of the account software, but it's because of the things, the sort of business tools that you can plug into it to really help deliver those consistent approaches to things. There's also sort of other sort of purchase ledger processing systems that automate data extraction. So it means someone isn't sitting there having to manually enter all the purchase invoices that you have for your business and allocate them to expense codes. This sort of pulls them in from emails, from scans, and gets it into the system with a link to the invoice, which, you know, if you're working remotely and things, having access to a system that has all the invoices linked and you can easily do a bit of investigation if you need to, is really, really useful. And then you've got the consistency of, you know, your supplier, maybe for sort of building materials or computer equipment, always goes to the same code, so you can always monitor things effectively. So from the purchases side, we tend to work with two together. So Receipt Bank processes the purchase invoices, but Approval Max works for businesses that have multi-level approval. So it avoids paperwork being passed between, you know, sort of, it feels really old fashioned now, the idea of passing paperwork between desks, because no one was really going to have desks for a while. But, you know, that's the idea, is that these things can be passed sort of through the app to the multi-stage approval and then go onto the accounting system. And again, you know, it's all on your phones, on your iPads, and it just flows really nicely and ensures that that person who's approving it has got a copy of everything they need. So they work really nicely for businesses. So another reason of why I'm a bit sad really, but I love the cloud accounting systems, is because of the way you can drill down into how your business is making its money. So there's really easy reports formats and ways to edit those to suit your business, along with kind of a bespoke dashboard. So anything that's really important to you can go on the face of the software. So every time you log in, it will tell you who owes you money or what's in your bank or whatever you need it to tell you. But also you have this way of doing almost like freeway reporting for profitability. So you can look at the business as a whole, but if you've got certain avenues or sales drivers, you can look at those independently and track those, along with the different types of sales or services you provide. And you can really drill down into which area of your business is generating sort of the most money for you, or if there's an area that's struggling. And I think that's often what gets a bit muddled in sort of just generic accounting. It also has the ability for you to look month on month or actual versus budget. And it's got a report. I mean, there's a report that we've sort of designed called the prior year report that I love, just because I think a lot of businesses don't necessarily consider themselves seasonal, but you know, even non-seasonal businesses tend to be affected by school holidays, particularly the summer and Christmas. And it's nice to see sort of December versus last December, so you can know if you're sort of beating yourself for the same time last month. And I actually feel that this is really important at the moment for businesses to have access to this information, because it's so hard to know the decisions you're having to make about staffing and sort of supply chains, how that's affecting your performance, and being able to compare to the same time last year for the same month is really useful. But then you can also look on month to see if there's trends of sort of a downturn or an upturn and react to those. And then it also has the ability to do sort of job costing. If you do project costing, you can put in your project costing and tag sort of expenses and things to that project, so you can see if you're overrunning before you get to a point where you've sort of racked up a lot of losses. And I think, you know, we're in a world where actually this information is now going to be really vital to businesses, and if you're not doing it, the chances are your competitors are. So what I would say is, in terms of cash flow planning, it's really important to understand your business's cash flow patterns, but also what cash you've got now and what debts might be coming up, and have a bit of a plan for those. Look at streamlining your finance, and then you can look at kind of forecasting different scenarios. And I think we are in a world where, you know, you could end up locked down again, or you know, you've got to be able to forecast these things. What happens if I have to lose 2 members of staff? Like, you know, how does that affect things? What does it save? And there's some really good sort of scenario planning tools, again, that work alongside sort of an accounting system and your accountant to help you sort of plan for these scenarios. And it might be that you need to shut a section of your business, and how does that impact things? So we tend to work with one called Float, which just gives you the ability to easily forward plan. So yeah, so that is, I mean, actually a system like Xero has multiple apps, sort of hundreds and hundreds, that sort of link into it. That's why I think it's quite popular in the business community, is because there's lots of apps out there that solve industry specific problems. So there's a whole array of them on their website, and we're quite good at working with our clients to work out what works best for them, to provide a sort of suite of business solutions to just make you as effective as you possibly can. So some of the things we help our clients with, we do personalised demos, we set up sort of not just the accounting system, but we can set up some of the apps as well, and look at training and designing in-house sort of processes so it all runs nice and smoothly. And we work with our clients on sort of report design and what's really, really important to them to know about their business. And we do something for some of our clients have in the past, where finance directors have sort of just disappeared overnight almost. We tend to work with them on a scoping document where we'd come in and we'd look at the entire sort of finance function and work out how they can solve some of their solutions, maybe in a more cost-effective way, by using technology to do some of the more sort of basic transactional stuff. So hopefully you've found that helpful, but I think that gives businesses quite a good foundation to sort of get their business in good shape at the moment. So does anyone have any questions for me?
Thank you very much, Emma. That was really informative. As I see, no one is having questions so far, neither on Zoom, neither on Facebook, where, by the way, we have more than 40 people watching it live. So I suggest we continue with Alex, with Alex presentations.
Yeah, over to Alex.
Hopefully everyone can see that. Yeah, I'm just going to give you a snapshot into some of the funding products that are available to businesses at the moment. We work with lots of different types of businesses. We work very closely with the Department of International Trade, so a lot of international businesses, and the lending kind of market at the moment is changing rapidly, and lenders are changing their criteria on a almost daily basis. So it can be a bit of a minefield. So what I'm going to do is just give you a snapshot into the main products that could be available, and an overview into what type of criteria that the lenders have on each of those products. So the first product is the Bounceback loan, which really has dominated the lending market over the past 6 months. So quite simply, this is a loan which is available to businesses, and the approval rate is extremely high. I think somewhere in the region of around 95%. And the Bounceback loan is available for most businesses, as long as they're not undertaking in difficulty or going through a CVA or something like that. And it's available up to £50,000. The main lenders offering this to businesses are banks to their own clients. So there are some businesses that I have been working with that may be with a more bespoke bank that don't offer it, but all the mainstream banks will offer it, and there's not many non-bank lenders offering it. So really, if this is something that you wanted to look at, you'd need to go direct to your bank. I think there's a six questions you need to complete, and on that, it's the approval kind of process is within 24 hours before getting the money in the account. In most cases, it can take longer, but I suppose that the main benefits of the Bounceback loan would be it's got a very low APR of 2.5%, which actually starts for the business owner on year 2. The government will pay the first year's worth of interest. Also, as well, there's no fees of any sort. You can pay the loan back early, and additional to that as well, there's no personal guarantees, which is quite a standard thing, really, and that's been stripped away. So the director of the business is not personally liable for that loan. The company itself is liable. Now, the next one is a little bit more complex than the Bounceback loan. It's a CBILS loan. So these loans start from 50,000 upwards. CBILS stands for Coronavirus Business Interruption Loan Scheme, and really it's designed for businesses that have a larger turnover than, because a maximum a business can get is 25% of their turnover under CBILS through multiple loans. So, for example, if a business had a turnover in the region of 400,000, they'd be eligible for £100,000 worth of CBILS loans. And it's worth mentioning that can be through multiple lenders. So you could have a couple of different loans from CBILS lenders, but what you can't have is a CBILS loan and a Bounceback loan. However, a lot of businesses do take a Bounceback loan because it's a very simple process to get it set up, and then once they've got that Bounceback loan in their account to help their immediate cash flow requirements, then they will go for the longer process of getting a CBILS loan, and the requirement of the CBILS loan is that the business would need to pay off the Bounceback loan. So they can't have both running at the same time, but they can refinance the Bounceback with the CBILS loan. So differently to the Bounceback loan, there are non-bank lenders that are offering CBILS. So the banks typically have although the rates are probably the best, the process is a lot longer with the banks. They typically would want cash flow forecasts, management information, long rationale into why you're looking for the loans, and their appetite is very slim. Now, there will be non-bank lenders who will be able to step in and actually offer an alternative solution to the bank, and what you'll find is that the application process is a lot slicker. They typically only want bank statements and accounts to process the application, so less information is required. The approval rate is higher, and what you'll also tend to find is that the banks will, I suppose that the banks will do it at a cheaper rate, but the non-bank lenders will have a wider risk appetite, but the rate will tend to be higher. So this is purely based on the strength of the company. So the banks, the non-bank lenders may look at things such as profit and turnover, but the non-bank lenders may have a risk appetite that's kind of outside of the banks. So you may get a yes with the non-bank lenders, but it may be at a slightly higher cost on that one. The rate can range anywhere on the non-bank lenders from a 3% APR up to about a 12%. And all the benefits really are the same. That there's nothing to pay for the first 12 months. The lender will pay all the interest and fees for 12 months. You can settle that loan early, and there's no personal guarantees up to £250,000. When you get over £250,000 from one lender in a loan, then there's they are allowed to take a personal guarantee. So the next one is a business loan. So this is a business loan. This side of the market has kind of paused over the past 6 months, or slowed down, and criteria have got tighter than what they were before. So businesses can get a business loan either from their bank, even though most banks are kind of focusing on the CBILS loans at the moment, but they are still offering business loans, all the non-bank lenders. So typically these are used if a business has maxed out on a Bounceback loan or CBILS and needs some additional funds. Also as well, it may be used if the business needs some funding very quickly, and you know, to pay staff, maybe to pay for stock, something like that, and they just need a quick injection of cash into the business. That's kind of often when it's used. So there's security wise, I say there's 3 different levels of security that a business could offer. There's unsecured, or secured just with a personal guarantee. There's secured on a second charge against a director's property or the business's property, or there's secured against a first charge on a property. So the rates will be affected by the level of security. If it's a very strong company with good profit, good credit, they'll tend to get a lower rate. And if it's a more high risk business that has not so favourable credit rating, or accounts maybe making losses, then the rate will typically be higher. So on the credit line side of things, this essentially is more of an overdraft style product, which the banks can offer, or non-bank lenders can offer. It's often used for businesses that may need cash flow just over shorter periods of time. So they may have a couple of days of the month where they're going into their overdraft, or they may need funds to pay for stock, pay for staff, and this often is kind of used as a safeguard for some businesses, just to protect their cash flow. A lot of people, it may be a cheaper option rather than utilising a business loan over the course of 3 to 5 years, that they can just dip in and out of this type of facility when they do have a cash flow shortage. So what you'll find with this is that typically the rates are a little bit higher than that of a business loan, but you do have that flexibility there, and a lot of lenders will have it sitting there where the business isn't charged if they don't use it. So a lot of clients that I work with will just have it there without paying any fees or anything like that, and if they need cash, they know it's available, so it just kind of protects their cash flow a little bit. So the next product I'm going to mention is Invoice Finance. This is simply a tool that businesses can use to free up cash in their unpaid invoices, as long as the goods or services are delivered. So rather than having to wait for 30, 60 or 90 days to get paid once your invoice is raised, you can get that cash flow into the business bank accounts straight away, which obviously frees up cash flow to be used elsewhere in the business. What you'll find is that most companies that turn over £2 million or more will use some type of invoice finance facility. The larger a company gets, the more common it is, and it's but there is a couple of variations of invoice finance. There's the more traditional form of invoice finance, where a business may commit themselves to a contract with a lender where they're having to finance all of their invoices, and are tied into I guess maybe a 12-month contract with a 3-month break clause in there. which is typically what the banks would look to offer. However, there is lenders out there now that will offer more of a flexible form of invoice finance. Typically, how that would work is the lender would give them a facility size, and they could dip in and out of that and actually just finance the invoices they want to, and then not charge if they don't. So again, like the credit line product that I mentioned just now, it does give more flexibility. Most, I suppose the pricing on the and the security available will depend on the business and who their debtors are, who their clients are. So if they're working with big blue chip clients such as Microsoft and Amazon, people like that, then it's going to be very low risk, and therefore the pricing is going to be reflected at a low rate. Whereas it's going to be a little bit higher if the business has, I suppose, clients who don't have a very good credit rating, or smaller or unknown to the lender. So that will boost up the price. Typically, the security wise, you can have it an invoice finance and completely unsecured, and again that will depend on the, I guess, the risk associated with the facility. Again, if a client, if the debtors are overseas or in a different country, that again can push up the price rather than being in the UK or maybe in a Western European country. So lenders can do it completely unsecured. They can do it with a personal guarantee. Lenders can request a debenture or charge on the company. That's typically what the banks would look for. But it really is on a case-by-case basis. And the next product leads on to that is trade finance. So trade finance comes at the front end of the trade cycle. So as I mentioned with invoice finance, that is once the goods and services are delivered to your clients, that's when you could free up the cash in that invoice. Some businesses may need the finance on the front end of the cycle. So how that would work is, if a business has a large order from a new client or existing client, which is typically bigger than what they're used to, but they want to take advantage of this type of opportunity. It could be something such as a furniture business has a very large order from someone like Amazon. So how trade finance would work is the lender would actually say, okay, you got a confirmed order from Amazon with good margin on the contract, profit margin. The lender would pay that your supplier up front. So you've got that. So then it will allow you to kind of take on that new contract. So it's the front end of the cycle where the lender is paying paying your supplier. Typically, how this would work is if you're buying a finished good, it gets a little bit trickier if you're buying parts in or ingredients or materials or anything like that, and you're putting it together and manufacturing it yourself. That would lead into supply chain finance. So there are lenders that can do that, but less of them. So I guess this is a good type of solution to a business that may have overseas contracts, larger contracts. It may be one where they got big kind of blue chip clients. This is available to new startup businesses as well, but the one thing with this is that the pricing is typically a bit higher than that of invoice finance, because in the eyes of the lender, the risk associated with it is a bit higher. You will find that most trade finance providers would require a personal guarantee from a homeowner in most situations. Okay, and the next one, the final product I'm going to mention is asset finance. This is very a very common type of finance that businesses will use, but there's a few different variations of it. The first type of asset finance that a business can use is if they want to buy assets. So they may have a forklift truck that they want to buy, and they need the lender to come on board and actually purchase that for them, and then they'll pay that lender over the course of 3 or 5 years for that asset. Typically, that's called hire purchase. So this is a very common thing if a business, that requires. It may be a manufacturing business, it may be a business that has a warehouse, it may be a construction business. They'll all use asset finance. But on the flip side of that, another type of asset finance that is available would be if a business already has a lot of assets that it owns, then what they can do is actually release cash in those assets. So they may have a forklift truck that they own outright, but they need some cash flow in the business. Well, what the lender then will do is actually give them a loan that's secured against that asset that they own, which is another way that a business can utilize their existing assets. There are lenders that actually can come on board and say, okay, you've got lots of asset finance from different lenders. We're going to take over all this asset finance and refinance it at a cheaper rate, and just with one lender, which I guess makes it easier for the business to kind of manage that cash flow requirement and manage the monthly costs of the asset finance. And I guess the final point on this is that there are different types of assets to lenders. So really the lenders would like what's called hard assets, which are kind of big chunky assets, like cars, forklift trucks, that type of thing. And then there's soft assets, which typically could be things such as computers. It could be things that are a bit more bespoke, I guess a bit lighter in terms of what they are, and typically what you find there is that the price will be reflected on that, and there'll be less lenders that are offering that type of finance. But there are solutions for most types of assets if a business is looking to purchase them. So I guess they're the main types of funding that are available. If you do have any type of funding requirement, we're always happy just to talk through things and come up with solutions. And a lot of the time, it may be a tailored approach where we can look at an overall finance package, which is a combination of some of the products that I've just mentioned. The CBILS Bounceback scheme is running until the end of November, which is the point where applications need to be submitted. So what I would say is that if you haven't taken advantage of this, it's unlikely to be extended now. So I'd say it's a really, really good way of getting cash flow into the business without any personal security. And the beauty of that as well is that you can borrow the money for a 12-month period. And if you want to pay it back, you can do, and it's not cost you a penny in interest or fees. So yeah, definitely worth looking at that, and happy to answer any questions that you have. Just send them through and we can answer them at the end. So I'm going to pass on now. I think it's Luke, is it, or is it someone else? Close this.
Yeah, I think it's Luke.
Yeah, okay. There we go. Stop.
Thank you, Alex.
Okay.
Share my screen. So I hope you can all see my screen and hear me loud and clear. Thank you, Neil. Thank you, Anna. Thank you, Madeleine, and all British Romanian Chamber of Commerce for the webinar today. Hope you're all finding it useful. Emma and Alex just touched on some really interesting points, and I think it leads quite nicely into what I'm going to speak about now. It's about businesses managing currency exposure at the moment. So I'm just going to look at very briefly what has happened recently, why I think now is a really important time businesses to look at their FX exposure and different products and tools to manage that exposure. And obviously I could talk about this for a lot longer than 10-15 minutes, but I'll try and cover it as quickly as I can and at as much depth as I can. So what has happened recently? Well, who'd have thought it? A year ago, everyone was talking about Brexit, and that seemed to be the only thing that we were talking about. And 1 year later, we are where we are. COVID and coronavirus has had obviously a huge impact, not just on the UK economy, but global economy and the Eurozone as well. I mean, just looking at the UK, the GDP figure in April showed a contraction of over 20%, which was the lowest number since record began. I think it's important to stress though that since then there has been a clawback in GDP growth, so numbers have been building up, and certainly in the currency market, sterling has recovered certainly quite sharply from that, but it's expected to be under pressure again if further restrictions come into place, as Neil mentioned right at the beginning. I think there has been a fading confidence in the UK government. Boris Johnson and his Conservative government, when they took over at the end of 2019, I don't think anyone expected them to have to manage the scenario that they found themselves in, but they have. And I think there's just a feeling among the business community that maybe they're not handling it as well as they probably should. But what that does do is breed nervousness and uncertainty for businesses. Businesses hate the unknown. They don't like not being able to plan for something. And I think that's where we're finding ourselves at the moment. And that uncertainty, sadly, I think is going to continue for the foreseeable, certainly around COVID, as restrictions are lifted and placed again. And that's going to have an impact on the economies and currency as such. There are other global events that we were talking about. I mentioned Brexit, but there are others as well. And I think it's just important to remember that those events haven't gone away, and we also need to keep one eye on that as well as it all transpires. So I wanted to show you a chart here. This is sterling against euro since the beginning of the year, and you can quite clearly see the impact that COVID had, or certainly the lockdowns in response to COVID had, towards the end of February and between March and April. We saw a 13% decline in the currency pair, and as I said, there was quite a substantial bounce back in that. So in a very short space of time, there was a 25 or an almost 25% swing in sterling to euro currency. And you know, some businesses that would be quite detrimental to their bottom line, especially when you factor in relatively tight profit margins, etc. There's been further volatility as the year's gone on, but as you can see, nowhere near as dramatic as it was at the beginning of the year. And the key thing for me at present day now is a lot of people ask, well, what's going to happen next? And the point here is that no one knows. And when businesses are looking to manage their currency exposure, that's a key thing to remember, that no one knows. And so, you know, making sure that you protect yourselves is of utmost importance. In real terms, if you imagine a business was looking to make €500,000 payment to a supplier this year, well, at the lows in mid-March, at the worst point during the COVID lockdown, that payment would have cost them £50,000 more than if they'd have done it at the beginning of the year, purely because of the change in the currency market. Now, that number would fluctuate, of course, as the markets move, and there's going to be continued volatility, and that number is going to continuously fluctuate around. But businesses then struggle to forecast, and Emma touched on it, with businesses looking to forecast at the moment. It's very hard to forecast and budget when fluctuations in the currency mean that businesses never quite know how much currency is going to cost them in their denominated currency for the next 12 months, for example. So it's really important that businesses try and manage this. And the good news is there are tools out there to manage this, and we will have a look at those in a moment. So why is now a good time to address your foreign exchange requirements if you're a business? I mean, I would say that it's always important to address it, but now probably more so than ever. But before I do that, it's probably good to fully understand who needs to address it. It's quite a vague term at the top there, but any business or any corporate business who trades internationally. Now, you might think you're a Romanian business who sells a product into Romania only, and so it doesn't affect your UK business selling into the UK market. It doesn't affect you. But where do you source your products from? Do you have to import them from overseas manufacturers, for example? Or are you selling into a global market outside of your own jurisdiction? In which case you may be taking receipt of foreign currency from clients. It might be as simple as a business who has overseas offices, but for reporting, accounting and operational purposes, they have to repatriate funds back into their own currency for reporting purposes. So any businesses that sort of fall into these categories, there will be more than likely at some point a reason to make or receive payments in foreign currency. And those are the types of businesses who need to focus on this. So I've talked about volatility, that word, I'm going to keep saying it. It's happened lots over the last sort of 6 months or so. And sadly, I think it's going to remain. COVID has not gone away. It's here to stay for the foreseeable. As I mentioned, that's going to create fear and uncertainty amongst the business community. And we've also still got Brexit to consider. As of the end of this year, the UK will be leaving the European Union. And dependent on the negotiations between now and then will impact where the currency ends up. That's for both sterling and the euro against other major currency pairs. And of course, in a post-Brexit world, there's going to be further obstacles and hurdles to overcome. Again, that's going to impact what happens to the currency markets. Maybe not as relevant, but I still think relevant to the UK and European markets is the US elections, upcoming US elections. There's an old adage that whatever happens in the US tends to have an impact across the globe and across all global markets. So I think it's very important to keep an eye on that. And at the beginning of the year, staying with the US, we were talking about the US and China trade wars and the sanctions they were imposing on each other on a daily basis. That largely has been pushed back in the last few months. It hasn't gone away. We need to make sure that we're keeping an eye on these events because they will have impacts on the global markets. So we've looked at what's happened. We've looked at why we think now is a good time to assess and address currency exposure. So how do you actually implement a strategy? I think it's important for every business. Every business is different. Their cash flow requirements are different. I think it's important first to understand your risks. Is it purely a cost risk? Do you want to look at reducing costs and nothing else? Well, yes, we can look at that. Is it more to do with timeframes of payments? And Alex talked about invoice finance, which is really interesting. If you can imagine you're paying an overseas supplier and on day one you agree a price, but you don't need to make that payment until day 30 or day 60. As a business, you will be exposed to currency fluctuations throughout that time period. So there are products, there are tools that are out there, and we can fit that into a bespoke FX policy for you, which can eliminate those risks. There are certain products called forward contracts, which allow businesses to purchase currency in advance, right the way through to much more sophisticated currency option strategies, maybe more for businesses who have much higher and intense cash flow requirements. But the key thing here is that all of these products, all of these policies are all about risk mitigation. This isn't about a business trying to make money from currency movements, although that is nice if it happens, but more often than not, it's luck. This is all about negating negative market movements and protecting your bottom line from that. And I think that's really key to stress, because I speak to a lot of clients who try to make money from FX markets. It's not what they do. It's not their core service. This is all about protecting your bottom line, protecting your business and your profit margins. So I will be summing up pretty soon, but I think the key things that we need to focus on as a business, there's three main things. Really want to be reducing costs. So you should be regularly assessing the costs that you're receiving from your bank or your FX provider with regards to the rates of exchange that you receive and any additional bank fees. we can very, very quickly do a benchmarking exercise where we can look back historically on your transactions and very quickly in black and white show you any potential savings over that period of time, which then gives you a more informed decision whether it's something you want to move forward on. So that can be done very quickly, and I recommend doing that on a regular basis to make sure you're getting the correct deal. Once you've done that, then it's worth looking, as I said before, looking at your risk points and potentially putting in place a suitable hedging strategy. For some businesses who might have only 1 or 2 payments a year, it may not be as relevant. But we work with businesses who are startups or looking to expand into global markets, right the way through to multinationals who have been dealing in quite sophisticated hedging products for a number of years, and everything in between. Every business is different, but there is a strategy out there that can help minimize risk. And lastly, just getting that personal service. It's all a bit of a cliche, isn't it, the personal service, but it's absolutely true. For us at Moneycorp, we have a number of global offices, but we do cover the whole of the UK, and importantly, we also have an office in Bucharest as well. So whether you're a UK business who's needing to trade internationally, or a Romanian business who's got overseas supply chains, we have that local presence that can help you personally and talk you through and give you some guidance on the pitfalls of exchanging currency wherever you are. So I will finish on that. I'll just leave my contact details there, but more than happy to speak through with you offline if you're already making transactions with currency, and to see if we can improve your offering, or if it's something that you'll foresee might be happening in the future. More than happy to sit down and have a non-obligatory conversation and just see if we can help at all. But like the others, I do welcome any questions. So if there are any questions, then we can go from there. But thank you very much.
Thank you very much indeed. According to my notes I'm getting from Anna, we have 122 people watching us on Facebook Live, in addition to those who are joining us here on Zoom. So I think that's one of the very best audiences I've seen for a Chamber online event. Thank you all very much indeed. This has been a little bit unusual for the Chamber because we've been doing many webinars since the start of the lockdown. And this has had much more of an emphasis upon UK rather than Romania, which is a nice change. Now, obviously, we've heard from Moneycorp about the international trade element, and if you've got business in both Romania and in the UK, that's obviously a key factor there. But I think the other products that have been explained to us, and also the tools that have been explained to us, is it fair to say that that is primarily aimed at UK companies, and that a Romanian company trading into the UK would be less able to access those? Or what about the position of a UK business trading into Romania? The Chamber itself is a UK, an English limited liability company with a branch here in Bucharest. So the Chamber is in that kind of position. So perhaps I can ask our speakers what their thoughts are on that, please.
I mean, in terms of the cloud accounting sort of element, it deals with foreign exchange and works actually really well with businesses trading sort of internationally. So that can all be set up quite nicely now. I think that is more expected now than it probably was sort of when accounting software was originally developed, but Xero is actually one that's been built around foreign exchange being dealt with as part of the accounting piece. So
good.
So just on the funding side of things, I suppose the products such as Invoice Finance, Trade Finance, they'll be available to Romanian businesses, but they wouldn't be able to get them from a UK lender. They'd need to go to a local lender, whether that's their bank or private lender. The Bounceback loan and the C-Bills loan are obviously a scheme that was set up for UK businesses, but I know that each country's government has their own local kind of products and support that's available to Romanian businesses. So that would be one that they'd have to speak to speak to their bank about.
Yeah, I think one of the issues we find members of the chamber is the company incorporated in one country, which has a business in another country, and whereabouts it looks to get that kind of support. But that's something we are able to pass back to the powers that be. Anna, do we have any other questions you've seen on Facebook?
No, on Facebook we have no questions for now.
Okay, if you want to ask a question, please post it on Facebook. Or any other questions here, please put onto the chat here on Zoom. If you're watching us on Zoom.
Anna, will our contact details be shared to the attendees today?
Yes.
Cool. Yeah. So I think all our contact details are on there, aren't they?
Yeah,
so
they can contact you afterwards if they have questions or they want to get in contact with any of you.
And I believe we'll have a recording of this available on the website.
Yeah, that's also true, and also on YouTube. So they will be able to see again the webinar.
And on YouTube. There we go. So it's something that we're really making this really accessible to members and to non-members. And if you're a non-member, please think about becoming a member, whether you're based in the UK, in Romania, or in other countries. We're happy to talk to you, see how we can assist with events like this and other services. Right, I think we are on the hour, so unless there are any other questions, and I don't believe there are, I'm not seeing anything come up. I think I'll say thank you to our three speakers for a most informative hour's discussion. I've never seen quite so many people watching us on Facebook, so well done there. Anna, what's our next event, please?
Thank you, Neil. Tomorrow we'll have a webinar on Brexit updates because it's time to give our members some guidance on how to prepare for change and future trading with UK. And coming up next, we'll have another webinar next week with our members, World Marketing Partners, learning what financial and marketing plan should any European have in order to enter the US market. We're looking forward to seeing you online, and check our website to check our events. I just typed in the chat box the website link. Thank you very much for attending today, and have a lovely rest of the day.
I would just start by saying thank you very much to Anna and to our other colleagues, Stefan and Madalena, for setting this up. Thanks again to our speakers, and thank you for participating. I would say that we have not forgotten about face-to-face events, but obviously, in view of what we're now hearing, we are looking very carefully at what face-to-face events it is safe to organize. So thank you all very much indeed, and have a good afternoon. Thank you.
Thanks so much for having us.
Yeah, thank you very much.
Bye.